Hello everyone. Quick video here to podcast explaining a couple of sticky items having to do with corporation taxation. We're going to start first with the idea of starting a corporation, forming it from scratch by having taxpayers contribute assets to the corporation. As long as the amount of the asset contributed is cash, no big deal. Just the cash exchange, the taxpayer basis in their stock is how much cash they gave up, and obviously the basis for the C corporation in that cash is what it's worth, and so there's no realized gain or loss or recognized gain or loss. Now what gets tricky is if there are other assets that are contributed. So for instance, in our example here, taxpayer A is going to contribute assets with a basis of $75,000, but they have a fair market value of $100,000. So there is a unrealized gain there, that is being exchanged for stock. So taxpayer A is going to get stock, you might say worth $100,000 because we're going to make this exchange at the fair market value. But their basis in the assets they give up is 75. But the tax law says that because if the taxpayer is qualified, then this is a non-taxable transaction and no gain will be realized when and recognized for tax purposes, which means that taxpayer A's basis in his stock is 75,000 and the corporation's basis in these assets that they are getting from taxpayer A is also 75,000. Now, obviously, if the same basis and fair market value is the same, like with cash, no biggie, no big deal. Okay, and taxpayer C here has a loss. Now it gets a little trickier. They still cannot record a loss on this transfer. So in this case, it actually works against the taxpayer. In terms of there is no loss recognized. So on this taxpayer C, their basis is $60,000 and the fair value is lower than that. So there's actually a realized loss in this exchange. When that is the case, which of course we would not recommend if we were the advising this client, taxpayer C. But if the basis is going to be, that would mean that when this property is contributed, we would, if we followed the same rule, the basis would carry over to the corporation and they would have basis of 60,000 in the new assets. But the rules prevent that from happening, so they would get basis of 40,000 because it can't exceed the fair value. Then the taxpayer C can elect, all right, to also lower his basis in the property, in the stock that he received, to that 40,000 as well. So then it would be even. So a little more complicated on the loss side, but we want to make sure you understand that it is not a taxable transaction typically. Now, what's tricky about this is they have to have control, 80%. They have to do it at the same time. So taxpayer A can't contribute and then wait 4 or 5 months and then taxpayer B, because the transaction has to result in 80% control. So they have to do this together, and it's not individually. If they're separated by time, then each one will be looked at and none of them will qualify because none of them will reach the 80% threshold. That's important to remember. So that's the formation of a corporation. Now looking at the special deductions that happen only apply to C corporations. We'll use an example here of Express Corporation has revenues of $370. That doesn't include dividends. Whenever you're doing a problem with having to do with C corporations, you need to understand if the revenues include dividends or not. Typically, in the textbook, they will not include dividends. It will be listed separately. So revenues, then the dividends separately, then operating expenses. So when you calculate the income before special deductions, you are going to take the revenues plus the dividends minus the operating expenses to get your income before special deductions. Now, in this case, they got a dividend of $120,000. They own 55% of the stock. So that entitles them to a DRD deduction, at least initially, of 65%, which is $78,000. However, there's a limit on the DRD, and that is it cannot be more than 65% of the income before special deductions. So whatever percentage you're working with, it can't be more than that percentage applied to the income. So in this case, your DRD would not be 78. It would be 65% times the 100,000 or 65,000, because it would be limited that way. All right. Now, if there was more, the dividend received deduction was high enough that it was under the old rule. Let's say we were back to doing 65% of the dividends, and that resulted in a NOL, meaning this number was higher than this number, right? Then you would still take the whole DRD without the limit on income. I know that's a weird rule, but if it's high, this DRD is high enough to be more than the income before special deductions, then you take the whole thing. You don't limit it by the percentage of income. So now, the other thing that there's really two special deductions, charitable contributions, which we know are limited to 10% of the income here before special deductions. So the most this Express Corporation could give and deduct is $10,000. Any excess is carried forward 5 years. And then if you are calculating DRD, you have to consider charitable contributions first, then the DRD. So as long as the charitable contributions are zero, you can go right to the dividends received deduction. Okay? But I want you to understand how the dividends received deduction works. It allows you to deduct part of what you received in dividends. That's the mechanics. It is 100%, but only when the dividends are received are from a corporation that you own over 80%. Okay? So make sure that in every other case, the dividends received is going to be less than the dividends you report as revenue or part of revenue or income. Only if it is over 80%, then the dividends here and the dividends here and the dividend received deduction would be exactly the same. And in this case, it would not be limited because it creates an NOL. It's actually higher, so you don't have to worry about it being 100% limited to 100% of the income before special deductions. So those are the tricky parts of it. If you remember to add in the dividends, to always consider charitable contributions first. Remember the limit on income unless it creates an NOL. And just remember that the mechanics of how the dividend received deduction works is to reduce how much is actually paid tax on by some percentage of the dividends. So you're going to offset the DRD against the dividends, but you still have to add in those dividends up here when calculating that.